Hey, happy weekend. It's Saturday, March 19th. This is Mark Hines with your 4-minute weekend review of the markets. So it was a great week for the markets this week on a short-term basis, right? This was the best week for stocks since 2020. All three of the major indexes were up. And the theme for this week, really, I've got two of them for you. The first one is clarity. We're going to talk about the clarity we got in the market this week from a couple different sources. And then second, income investing. And I'm going to explain a little bit what I mean by income investing. But just to give you some numbers on the week, the S&P 500 was up 6.1% for the week, which is a really big number. The tech-heavy NASDAQ was up 8.1% for the week, which is just huge. Typically, that's sort of an annual type return we saw in the last week. And then the sort of blue chip Dow Jones Industrial Average up about 5.5%. So really big moves. A lot of people are excited about that, about the moves in the market over the last week. But just to kind of temper your emotions at the point right now, year to date, we're still down, right? The S&P 500 is down about 7% for the year. That's a lot better than we were talking in the last few weeks. We were down double digits. So it feels good to be, feeling like we're rebounding and going the upside. NASDAQ is still down double digits, about 12.3% for the year. And then the Dow Jones is down around 5% for the year. So let's talk about what happened in the market and why we're getting these big moves. The first theme I want to talk about is clarity, right? The market, generally speaking, hates uncertainty. And when there's a lot of uncertainty out there, people are scared and they sell their stocks, they sell their risky assets like stocks. So basically, we got clarity on two fronts this past week. The first thing we got was from the Chinese government, which may sound a little bit odd here in the US, but the Chinese government has been cracking down heavily on tech companies for the last over a year now. So they came out with big news this week, and they said basically the tech crackdown is almost over. And when they said that, a lot of these beaten down sort of Chinese tech stock, American depository receipt names, they just shot up. They went up big. So one example is Alibaba, a huge tech company in China, just massive amounts of revenue. This is one that we hear stories about Charlie Munger taking a sizable position in recently. Basically, Alibaba was up about 35.5% on the week, which is just huge. And there were other Chinese names out there, and Baidu, for example, and other names that are sort of associated with China that were just up really big in the last week. And what happened was we got that clarity from the Chinese government, and the market really liked that. The second big piece of clarity we got here in the US was from the Fed. Excuse me. The US Fed had their big interest rate, target Fed funds rate announcement on Wednesday of this week, and they raised rates 25 basis points, which was basically what was expected, right? They went from, in the last 6 months, they went from 0 to, maybe we're going to have a 50 or 75 basis point increase to 25, but 25 is kind of what people were expecting. But so that provides a little bit of clarity, but what really helped was they kind of gave the trajectory of interest rate expectations for the rest of this year. They're saying or targeting about 6 more target Fed funds rate hikes through the end of the year, and the market really liked that clarity. Some of those stocks, some of those riskier stocks or higher growth stocks had been getting beaten up pretty badly with sort of the uncertainty around interest rates. So the market really liked that. So those two big, clarity points, one from the Chinese government and one from basically the U.S. government or Federal Reserve, and the market really liked that. So we had a great week for markets. So clarity was that first theme. The second theme I wanted to talk about was income investing. And if you're an income investor, there is ongoing challenges out there, right? If you're a saver and you've got your money basically sitting in, a bank account, you're dealing with a couple big things right now, right? One, low interest rates, right? We know the Fed is expected to raise rates, but rates are still very, very low. You're not earning a lot of money on your investments. I think the 10-year Treasury is over just a little bit over 2% now, and that's the safest asset, right? You put your money in a U.S. Treasury, you lock it up for 10 years in theory to get that money back, and you're only getting a little over 2%. To put that in perspective, back in 1982, you got over 15% yield on that 10-year Treasury. So think about that. If you could buy Treasuries back then and earn, 15% return, that was nice, guaranteed by the U.S. government. But we're not there now. So those low interest rates are hurting people who like to save their money. But then that's dramatically compounded by the high interest rates that we have right now. excuse me again, or not high interest rates, I mean high inflation we have right now. Again, the last 2 months in January, year-over-year inflation number was 7.5%, which is very high. February was 7.9% on that sort of CPI, Consumer Price Index number. So prices are going up. You've probably seen it. You've seen it if you're filling up your car with gas. You've seen it at the grocery store. You've seen it if you're buying food, right? Prices are going up a lot. And what that means, again, if you had $100,000, stashed away that you were saving, and inflation is 7.9% year-over-year, you lost a lot of buying power, right? You can buy roughly $92,000 worth of stuff this year. That's painful, right? For just having your money, just holding your money. So inflation is a big challenge, but in my opinion, inflation is not going to stay this high forever, right? They talk about, oh, is it transitory? Is it not transitory? What does transitory even mean? Is that short term, long term? In my opinion, there's a couple things going on. One, we've got the impacts of the pandemic, right? The government put out lots of stimulus, mailed out stimulus checks, kept interest rates really low, doing a lot of things in the market to kind of stimulate the economy. And that's what really pumped inflation up. But we're going to see the sort of impacts and effects of those things start to roll off a little bit, right? When they do those sort of stimulus activities, they don't take effect right away. The pandemic, right, started hitting in full force in the US sort of late February of 2020. So they started taking some of these stimulative activities and actions in the US government, and those things don't take hold right away, but they have. And the inflation number is a year-over-year number. So we see big inflation numbers. My expectation is it's going to taper off somewhat, right? It's not going to go down to zero. It's not going to go backwards either, right? So you're not going to all of a sudden get that buying power back. It's lost. But I think some of those sort of pandemic stimuli type things are going to roll off, and those inflation numbers are going to come down. And then the second thing is the Fed is taking a lot of action. They're scared, and they're taking it very seriously. Inflation is a problem. They'd like to get inflation back down to a more normal level, maybe around 2%. That would be nice. So they're working hard to get inflation down. But it still creates huge challenges for savers with the low interest rates and the inflation. For me, when I work with income-focused investors, I like to use a combination of different sort of income investing type of investments. And it depends, of course, on everybody's individual needs and their goals and their tolerance for risk. But everything from bonds, real estate investment trusts, some of those business development companies, some of these closed-end funds are trading at wide discounts right now. I think PIMCO is famous for some of these high yield bond closed-end funds that historically traded these big premiums relative to their net asset values. Those premiums have actually come down a bit, and some of those are particularly attractive. Even though we have rising interest rates at this point, now that we have that clarity on interest rates, hopefully there won't be as much volatility and uncertainty in those prices and those discounts that we're seeing on some of those PIMCO CEFs. PDI, for example, is a ticker on one of them. They're attractive right now, depending on your goals and depending on your needs. So that's a lot of information for the week. But again, best week for the market since 2020. We got a lot of clarity, right? Clarity from the US Fed, clarity from the Chinese government. Still challenges out there for income investors. I'm going to leave you with a little bit of a contrarian viewpoint, right? A lot of people are excited right now. We had one big week in the market, and it was a very big week in the market. But just to kind of put that in perspective, the challenges are still there, right? Still low interest rates, still the conflict going on in the Ukraine, a lot of challenges that are very, very real in the world. So I'll give you a stat here, right? And it's a stat I heard that kind of, it made me concerned, right, for investors. And the stat is related to the dot-com bubble, right? If you remember, in sort of late 1999, we had this dot-com or tech bubble building up where tech stocks got really expensive. And that bubble started to burst in around, I guess it was March 10th, maybe was the peak of 2000. It took 2.5 years for that tech bubble to burst. And all told, from peak to trough, the NASDAQ, tech-heavy NASDAQ, was down around 76%. Now it's made up all those losses and more since then, right? The power of long-term investing, the power of compound growth. But from a shorter term perspective, a lot of people kept trying to call a bottom in the tech bubble, right? As that tech bubble started bursting in whatever it was, the year 2000, March of 2000, after a few months, the market's down, 10, 15%. People are like, oh, that's it. I'm calling the bottom. I'm buying tech stocks. Falls another 10 and 15%, right? Oh, this is the bottom for sure this time. Dump more of your assets in there, dump more money in there. And people just kept trying to bottom ticket, right? They'd see these, like we saw this last week, they'd see a really strong week in the market, and they're like, oh, that's it. Stocks are healthy again. I'm buying, and they ended up being wrong, and they were wrong for 2.5 years, and they saw the value of their nest egg decrease for 2.5 years. So sort of the moral of the story is two things, right? Number one, don't get overly excited because we had a really good week in the market, right? Number two, short-term investing is a little bit of a fool's errand, right? You can't really predict the short-term moves in the market, but what does tend to work very well is disciplined, long-term, goal-focused investing, which is what I believe in. So I'm just going to leave you this week with, we had a strong week. I'm optimistic. I'm optimistic that inflation's coming down. I'm optimistic that the market's going to get better. But stay focused on your long-term goals, right? Don't get overly excited. Don't ditch your goals. Disciplined long-term investing is a proven strategy for success, and I think it's going to work this time too. So that's it for this week. Thank you very much, and I will see you next week.